I want you to just, for a second, picture your morning routine. You wake up, maybe you grab your coffee, you open your phone, and you try to see what's happening in the markets. And it is just an absolute avalanche.
It's a fire hose. There's really no other way to describe it.
Right. I mean, you've got thousands of news articles dropping every single hour. You have earnings calls that are 50, 60 pages long. You have CEOs tweeting something at 3 a.m. that sends a stock spiraling. And I always just look at all of it and think, how?
Yeah.
How is any human being supposed to read all this, let alone, understand it well enough to make a good decision?
Well, short answer, you can't. Not anymore. I mean, if you're trying to understand the modern market by, manually reading the Wall Street Journal with a highlighter, you're bringing a knife to a nuclear fight.
That's a terrifying image.
The sheer volume of data has just outpaced our ability to process it.
Well, that sets the stage perfectly for what we are diving into today. We are talking about financial sentiment analysis.
Yeah.
Now, before you tune out, because that sounds like some dry academic term.
I know.
Let me set the stakes here. We are not just talking about counting how many times the word recession shows up in a headline.
No, we are so far past that. We're talking about using AI to really decode the actual mood of the market. We're talking about algorithms that can read 5,000 articles a day, understand sarcasm, understand nuance, and according to the research we have today, predict volatility.
So we have a stack of 3 really fascinating papers today that kind of map out this whole revolution. First, we've got a study by Ruyu Chi that sets the foundation. It shows how we went from, simple word counts to these massive brain-like models.
That's the big picture paper. It really connects the dots between what an AI reads in the news and how the VIX, the volatility index, actually moves in the real world.
Then we have a study by Faturos and his team that takes us into the foreign exchange market, Forex.
A tricky one.
And this one is basically a grudge match. It pits a specialized, finance-trained AI against the chatbot we all use to write emails.
ChatGPT. And the results of that, well, they're honestly surprising. It challenges a lot of our assumptions.
And finally, we have a paper by Tsai and their team that goes deepest. They're basically saying, forget happy or sad. They're doing something called argument mining.
Yeah, they're building teams, ensembles of AIs to figure out the logic of financial arguments. The why.
So our mission today is to figure out how we got here. How did AI evolve from a glorified spell checker into a seasoned financial analyst? And maybe more importantly, if an algorithm can read the entire financial internet for the price of a sandwich, what does that mean for the rest of us?
That's the question.
Okay, let's get into it. Part 1, the evolution. Walk me through the history here, because trying to read the tea leaves of the market isn't new. How did we used to do this?
Well, the old way, as the Chi paper calls it, was what's known as a lexicon-based approach.
Sounds fancy.
It does, but it's actually pretty primitive. Imagine you have this giant dictionary.
Yeah, I've got the dictionary.
And in this dictionary, someone has manually gone through and tagged certain words. Growth, profit, gain, those get a positive tag.
And loss, default, crisis get a negative one.
Exactly. So you feed a news article into the machine, it counts the positive words, subtracts the negative words, and spits out a score.
So it's basically just high-speed word search.
That's all it is.
That sounds, incredibly brittle. Language isn't that simple.
It's not functional at all for real analysis. Because you're right, language is messy. The classic problem is negation. A CEO says, we are not anticipating a loss.
The old model just sees the word loss and panics.
Exactly. It flags it as negative, completely misses the knot. Or sarcasm. If you say, oh, great job crashing the economy, it sees great job and thinks everything is fine.
Right. And financial jargon must have been a nightmare.
A total nightmare. Take the word liability. In normal life, that's a bad thing. In accounting, it's just a normal part of the balance sheet. It has no feeling. But the old models couldn't tell the difference.
Okay, so this is where the Chi paper brings in the new era. This is where large language models, LLMs, come in. The big ones like BERT and GPT. What is the fundamental difference?
The key word, really, is its context. LLMs don't look at words in isolation. They look at the relationship between words. They see the sentence before the sentence after. They understand that bullish is good for a stock, but a bull in a china shop is very bad for management.
They're reading for meaning, not just matching words.
They're paying attention, and the Chi study specifically looked at how this connects to volatility. They wanted to see if these smarter models, by reading the news, could predict when the market was about to get turbulent.
The VIX, right, the so-called fear gauge.
Yep, and they found a very strong, very quantifiable link between what they called extreme sentiment and that market volatility.
define extreme for me. Is that just everyone being super happy or super sad?
It's both. When the sentiment from these models swings hard to positive think irrational exuberance, or hard to negative outright panic, the VIX tends to spike. It captures that uncertainty. Basically, when the news gets emotional, the market gets shaky.
That makes a lot of intuitive sense. But did it actually help them predict anything?
Yeah.
Or was it just an interesting correlation?
Oh, it helped significantly. This was the kicker from their simulation. When they put these sentiment variables into their prediction models, they made fewer errors. Way fewer than models that only looked at past prices.
So looking at the mood actually made the math better,
Much better. They used metrics like RMSE root mean square error.
which is just a fancy way of saying
Oh, wrong was I.
less S. Okay.
It just measures the distance between the prediction and what really happened. Lower is better. And when they let the AI read the news first, that error rate dropped. It proved that sentiment isn't just noise, it's a real signal.
Okay, so that's our foundation. AI can read context, and that context helps predict when the market's going to get choppy. But let's dial up the difficulty. Because reading stock news is one thing. Apple sold more iPhones. It's pretty clear.
Right.
But the Futuro's paper takes us into Forex.
The foreign exchange market, a whole different animal.
And honestly, Forex is scary. It feels infinitely more complicated. Why is sentiment so much harder there?
Because in Forex, everything is relative. There's no such thing as just buying dollars. You're always buying dollars and selling euros, or buying yen and selling pounds. It's always a pair, a tug of war.
So a headline could be good for one currency, but that means it's bad for the other side of the pair.
Exactly. And the Futuro's paper gave this perfect example that just breaks almost every traditional model we just talked about.
Was this the Canadian dollar one?
Yes. The headline was, CAD is one of the better places to sell the US dollar on a pullback.
Okay, let me try to parse that. So CAD is the Canadian dollar, better place, sell US dollar.
Now imagine you're a standard AI model. You see better, that's positive. But then you see sell, which is almost always negative, and you have two different currencies.
The AI has to figure out who the winner is and who the loser is in that sentence.
Right, and for that specific headline, the sentiment is positive for the Canadian dollar, but it implies a downward move for the USD CAD pair. A traditional model just gets confused. It has no idea who the subject is.
So how did they solve this? Did they build some super specialized Forex brain to untangle it?
That's what you'd think. And they tested that. They used a model called FinBERT.
FinBERT, I'm guessing the fin is for finance.
Yep. It's a version of BERT that's been force-fed millions of financial documents. It's gone to finance school. It knows the jargon.
Okay, so that's the specialist, the heavyweight contender.
And they put it up against ChatGPT 3.5, the generalist, the chatbot that, writes poems and suggests dinner recipes.
The jack of all trades.
Exactly. Guess who won?
Given the buildup, I'm going to guess the jack of all trades.
It wasn't even close. The generalist crushed it. ChatGPT 3.5 outperformed FinBERT by about 35% in accuracy.
Wait, 35%? That's not a small margin. That is a blowout. Why? If FinBERT is the specialist, how did it lose so badly?
It all comes back to that word, context. See, FinBERT knows financial vocabulary really well, but ChatGPT has read, everything. It has a much broader understanding of language, of nuance, of logic. It could parse that tricky sentence because it understood the grammar of the trade, not just the keywords.
But they didn't just paste the headline in and ask, is this good, did they? I remember reading about prompt engineering in this paper. That seems like a really crucial detail.
It is the crucial detail. This is the aha moment. They used what's called zero-shot prompting with a persona.
A persona? You mean like acting?
Literally role-playing.
Yeah.
They found the best results didn't come from just asking what's the sentiment.
Okay.
The best results came when they told ChatGPT, and I'm quoting here, act as an expert at Forex trading. Will you buy, sell, or hold based on this news?
That is wild. So just by telling the AI to pretend it's a trader, it completely changed the analysis.
It primes the model. Think of the LLM as this massive library with all of human knowledge. When you say act as a trader, you're telling it, go to the finance section of the library. Only use the books on that shelf. It accesses the specific patterns and logic of that role.
So when it's acting, it knows that selling the US dollar against the CAD is a specific actionable signal.
Exactly. It adopts the mindset. And this wasn't just theoretical. They checked it against actual market returns. ChatGPT's scores had a 36% higher correlation with what the market actually did compared to FinBERT.
So the robot that can write me a limerick is also a better currency trader than the finance model, as long as you ask it to pretend.
It really suggests that, general reasoning ability might be more important than just domain-specific training. You need a brain that understands the world, not just a dictionary.
That makes sense.
Yeah.
But let's go one step further. We've talked about mood, we've talked about context. But the side paper, this one felt the most technical, but also the most futuristic.
Yeah.
Because they're saying feelings are nice, but what about the logic?
Exactly. They're moving from sentiment analysis to argument mining.
Argument mining. It sounds like digging for gold in a debate club. Break that down for us. What are they actually mining for?
They're mining for the structure of an argument. They are teaching an AI to break down text into what they call argument units, specifically separating the premise from the claim.
Okay, I need a concrete example.
Think about an analyst report. A claim is the opinion. We believe our stock price will double next quarter. That's a claim.
Got it.
The premise is the evidence. It's the because. Because our widget sales are up 50% and we cut costs by 10%.
So the model isn't just looking for double stock price equals good. It's trying to understand the logical connection. The because.
Yes. It's trying to map out this statement supports that one, or even this statement attacks that one, and figuring that out is really, really hard for a computer.
So how do they tackle this? Another round with ChatGPT.
No, they took a different route. They use an ensemble.
The Avengers strategy.
That's a good way to put it. Instead of relying on one AI, they built a team. They used BERT, Roberta, Electra, all these different models, and they had them vote.
I saw that in the notes. Soft voting and hard voting. What's the difference?
Okay, so hard voting is simple majority rules. You have 5 models. 3 say this is a premise. 2 say this is a claim. The result is premise. The majority wins.
Pure democracy.
Right. But soft voting is more nuanced. It looks at the probability. Let's say one model is a genius, and it says, I am 99% sure this is a premise. And 2 other models are kind of confused and say, hey, I'm 51% sure this is a claim.
In a hard vote, the 2 confused models would win.
Correct. But in soft voting, you average the probabilities. So that one highly confident model can actually sway the final decision. It values conviction over just head count.
Which makes sense. You want to listen to the expert in the room. Which one worked better for them?
The top 4 soft voting ensemble was the winner. By taking their 4 best models and averaging their confidence levels, they hit a macro F1 score of over 77% for identifying these argument units.
That is impressive. But they ran into a problem. What I think anyone who follows business news would recognize, everyone is always so polite.
The imbalance problem. This is a huge issue in financial data.
Right. On an earnings call, you hear a lot of, we agree with the strategy, or our results support the outlook. You never hear a CFO say, that analyst is lying and his math is garbage.
No, you don't. Disagreement is professionally dangerous. So in the data, support relationships are everywhere. But attack relationships where one statement contradicts another are maybe 1% of the data.
And if you train an AI on that, doesn't it just learn to ignore the attacks? The safest bet for the computer is to just guess support every single time.
Exactly. It's the finding a unicorn problem. The model gets lazy. So to fix this, Sai's team used a technique called the log likelihood ratio, or LLR.
Okay, that sounds like math homework. Plain English version.
Sure, think of it like looking for a linguistic fingerprint. They analyze the text to find specific pairs of words that show up way more often in attack arguments than anywhere else.
So finding the clues of a disagreement.
Yes, maybe it's words like however, contrary, or despite appearing near financial terms. Even though attacks are rare, when they do happen, these words tend to show up. By highlighting these word pairs for the model, they force the AI to pay special attention to them.
It's like giving a detective a clue sheet so they don't miss the small details.
Precisely. It prevents the model from getting lazy and just assuming everyone agrees. It forces it to hunt for the conflict.
That is incredibly clever. So let's recap this stack we've built. We've gone from counting happy words with a dictionary to role-playing traders with ChatGPT to now an ensemble of AIs hunting for the very logic of an argument.
It's a massive leap in capability in a very, very short amount of time.
But, and there's always a but, let's talk practicality. I mean, usually this stuff is only for the giant investment banks. But the Futuris paper had some really surprising numbers on cost.
They did. And this is the part that should make everyone sit up straight. They calculated the cost of using the ChatGPT API to process a Bloomberg-level volume of news.
Which is, what, thousands of articles a day?
About 5,000 articles a day. To run all of that through their best prompt setup would cost About $6 per day.
$6.
$6.
I spend more than that on my morning coffee.
Exactly. This isn't just for hedge funds anymore. The barrier to entry has completely collapsed. You can have an AI analyst reading the entire financial world for the price of a sandwich.
That is both exciting and terrifying. Because if everyone has access to it,
Is it still an edge? That's the big question. But before we get there, we have to talk risks. Because it's cheap, but it's not perfect. The cheap paper brought up a big one, the black box problem.
the classic AI issue.
It is. We know what the model predicted. We know it thinks volatility will spike, but we don't always know why.
If a human analyst tells me to sell Apple, I can ask why,
Yeah.
and they'll give me a reason. If the AI says sell Apple, and I ask why,
It just gives you a probability score based on millions of hidden parameters. It can't always explain its reasoning in human terms. And in high-stakes finance, the computer said so is a pretty scary justification.
and the models still need good data to work, right? I think the Futuro's paper mentioned some currency pairs were harder than others.
Yes, specifically the EU-RCHF pair, the euro versus the Swiss franc.
Why that one?
There just wasn't enough news about it. These models are data hungry. If the news flow dries up or a market is too niche, the AI starts guessing. It needs volume to find a pattern.
So it's not a crystal ball. It's a very powerful pattern matcher. And if there's no pattern to match, it's useless.
Correct. It can't invent insight from nothing.
So what does this all mean? Let's zoom out a bit.
Well, look at the journey. We started with Qi, and we saw that we've moved from simple word lists to LLMs that can quantify market mood and actually predict volatility. So, step one, the mood matters.
And we saw with Futuro's that context is everything. In Forex, you need to understand the relationship. And the key to unlocking that was telling ChatGPT to role play as a trader. So, step two, the persona matters.
And finally, with Psi, we saw we can go even deeper. We can use these AI teams to map out the actual arguments, the claims, the premises, and find the rare disagreements. So step three, the logic matters.
It really feels like we're crossing a threshold. For the longest time, the edge in trading was just having information first.
Right, having the fastest telegraph or the Bloomberg terminal on your desk.
But now, if anyone can process 5,000 articles a day for $6, the information itself is commoditized. You can't beat the market just by having the news anymore.
That is the so what here. You're not competing on access to news. You're competing on your AI's ability to interpret it. The edge shifts from having the info to having the best prompt.
Or the best ensemble.
Exactly. It becomes a battle of algorithms. Who has the better prompt engineering? Who has the better voting system?
So here's a thought to leave everyone with. We talked about how these models predict volatility based on the news. But what happens when most of the trading is being done by these exact same models? If every algorithm reads the same bad headline, uses the same expert trader prompt we just talked about, and decides to sell at the exact same millisecond, does the AI predict volatility, or does it start to create it?
That's the provocative question. If we all use the same brain to think, we all panic at the same time. It's a feedback loop of robotic panic. And that is something the models might not be able to predict because they're the ones causing it.
Something to think about. Thanks for listening to The Deep Dive. We'll see you next time.